Well, hello and welcome back to another episode of the StoneX Australian Cattle and Beef Market Report. My name is Ripley Atkinson. I'm the Australian Meats and Livestock Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian livestock industry to help the sector manage market and price volatility with our Australian feeder cattle forward contract. We're brought to you by StoneX Group, a Nasdaq listed global financial services network with 100 years of experience in global commodity markets. Remember that the trading of derivatives, such as futures, options, and over-the-counter products or swaps, may not be suitable for all investors. Derivatives trading involves substantial risk of loss, and you should fully understand the risks prior to trading. Past results are not necessarily indicative of future results. Well, today we're back on for a markets update. I'll kick off with exports and a bit of a run through on how the numbers look year to date. We got April figures, monthly figures out earlier this week. I'll get into the Angus to crossbred price spreads and premium and where that's currently operating. May is traditionally the time when we see that start to diverge and those Angus rates or the spreads widen quite quickly. So I'll get into that and then wrap up with where we're looking for the month of May. I really feel like this month is going to be quite pivotal to shaping how the market performs through winter and the dry season of 2026. And there's a little bit in that which I think will contribute, which we really need to see play out over this month. But kicking off on the export front, as I mentioned, DAF released the April figures on Monday. Really solid performance again, particularly considering the disruption April brings with a number of short working weeks. But overall, volumes were very solid. We're really continuing to see this export performance outperform. Monthly numbers hit a touch under 141,000 metric tonnes. Again, that's an April record, up about 11% or nearly 14,000 tonnes on the April 25 figures. So really pleasing to see the strength of those results on the back of, as I say, a disrupted month generally. Year to date, though, I think is what's really impressive. And when we start to see the ABS, or when ABS releases their, I think we're going to see it really in the Q2 numbers, but when ABS releases the Q2 slaughter and production numbers, we should begin to see slaughter numbers start to align with the strength in exports. So year to date, export volumes up 15.5% or nearly 70,000 tonnes on year to date 25 figures. What I mean by the first half of calendar year 26 slaughter numbers aligning with exports, because of the delay with ABS reporting, it's hard to quantify what that looks like. So at the minute, we're only tracking 5% in front year-to-date numbers on NLRS slaughter, but it's likely, I believe, when we get those Q2 numbers, we should see those slaughter numbers start to look closer to, 10 to 12% potentially higher growth year on year. And I think we should begin to see that align with where exports are. Exports are really the lead indicator to where slaughter should be performing or is performing. And with the release of that Q2 ABS data from the ABS for slaughter in August, we'll be able to then quantify that. But I think, as I mentioned, the 15.5% growth year on year, really pleasing to see. It shows how significant the increase is. There's obviously a few factors. Naturally, that push to China is well and truly a real role player here. Exports up to China year to date higher by 30%. And on a monthly level, we're really seeing exports to China at the minute nudge those record levels we saw in 2019 and early 2020 when there was that real push to get product into that market because of African swine fever and basically the protein deficit the country was experiencing on the back of ASF and what it did to decimate the Chinese domestic pork herd. But it's not just China. We're seeing good growth across a number of other markets. I think the other thing to consider on the export level, and I just mentioned it, is how strong slaughter numbers are. Through the month of April, we saw slaughter figures based on the NLRS hit their highest level since 2019. But when you adjust that to account for those processors across Australia who don't report their weekly numbers to MLA, we're really looking at the highest weekly slaughter volumes since the 70s. And obviously, those higher production levels, coupled with strong carcass weights, is really driving higher overall beef output, which is flowing through to those really strong export results. So it's not just China sucking up more product, which is influencing um, these higher export numbers. And obviously, at a domestic level, you're seeing processors and brands and feedlotters pull forward cattle on programs to get product into that market. But it's also this domestic factor of higher slaughter, strong carcass weights driving higher beef production. When we get to, how this is performing at the minute and what my views were back in February when I released the H1 26 Outlook report for the Australian cattle and beef market. When I update these numbers in June for the July release of the H2 Australian cattle and beef market outlook report, I'm of the view we may see slaughter and those new forecasts I'll put forwards. We may see that slaughter forecast nudge closer to 10 million head, which would be a pretty significant lift on the 9.28 we processed last year. But the way we're currently operating and the additional shifts coming online or that have been added by processors, I think there's a real chance we could see another really strong growth in slaughter volumes again this year. And I think it's worth raising now because of these additional shifts coming online for processors, the pipeline of cattle supply we've got for the remainder of the year. But off the back of that, exports, as I mentioned, I think will also have to be revised higher from my original forecast released in February. I don't think 1.7 million metric tons for calendar year 26 total beef exports is out of the question. Something to keep an eye on. Topical as it is, I've raised China, but also worth considering the Middle East at the minute. Dubai is a major market of ours, obviously very affluential and high disposable income country. There's a lot of consumers there with money to spend. It's an important market for us because it is lucrative and we send a lot of chilled product in there. Exports to Dubai down 30% year to date or year to April. Despite that, we are actually seeing some good results in other countries. Now, Saudi Arabia is not as big a market as Dubai, and it could be argued it's not as lucrative or as high value. Exports to Saudi are up 21%. So despite this disruption in the Middle East and the conflict occurring at the minute, obviously access through the Strait of Hormuz, things like that, we are still seeing some good results in that country. And I think, or in that region, I should say, and it's important to acknowledge some positivity there. Other important countries, which it is disappointing to see, but it is what it is. Indonesia exports down quite sharply again this year. But in saying that, Canadian exports are soaking up, or Canada is going to replace Indo as our fifth biggest export market in 2026. It's going through similar herd cycle challenges as the US with a reduction of domestic supply because of drought and herd liquidation. And we're really seeing good performance into Canada, which I think is partially offsetting some of that decline we're seeing in Indo and other places for that matter. The UK continued strong growth. We're off a low base, but on percentage terms, it's well up above 100% growth year on year. Good to see. It's a high value market. It's an important one for us. And I know in export circles at the minute, watching that market quite closely for potentially some positive news to come from that moving forwards. Stepping away from the export space and looking back here domestically, Angus to crossbred or Queensland flatback spreads is something I comment on quite regularly on this podcast. And I think it's really important, again, to monitor in 2026 for a number of reasons, namely, really the lack of Angus fetus supply going to be available to the market between now and September, October of 2026. Obviously, northern New South Wales is the engine room of that supply, and as has been well documented and well discussed this year, generally there's just not going to be those cattle there on an oats crop or forage crops to be made available to market through winter and obviously into spring as well. Cattle have been turned off as weaners rather than being held through to feeder weights, and they've moved out of those regions. And when you think about where they've gone, either into the west of New South Wales, north into Queensland, or south, down into southern New South Wales, Victoria, South Australia, those cattle at those lighter weaner weights aren't going to be ready to be turned off until when they're traditionally expected through spring. And because an oats crop couldn't be planted in 2026 in these northern New South Wales or central eastern Australian regions due to a lack of subsoil moisture and rain, there's not going to be those cattle available, trade cattle that those regions traditionally purchase to be turned out through those winter months. Processors and feedlots, particularly feedlots, have gone quite hard on adjustment and sourcing supply of those cattle to put away in paddocks to try and mitigate some of the supply risk they've foreseen coming. But ultimately, it's not going to address the natural shortfall that we're presented with, which brings us to this price spread relationship. Recently, in the last, say, 4 to 6 weeks, that spread's really started to widen. At the minute, based off Argus Media's Northern Angus Feeder Steer Index and Argus Media's Northern Feeder Steer Index, which is basically a crossbred or flatback steer, both of them delivered within a 300 and 400k radius of the Darling Downs. That spread at the minute, based off Argus pricing, sitting at 71 cents. Now, that's 13 to 14 cents higher than the same corresponding week in 2025, which gives you a bit of an indication of how sharp that widening has been. But I think the distinct difference in 2026 or this year as to why that spread has widened has actually got to do with the softening and easing in the crossbred rate rather than the acceleration or lift in Angus prices. For the last 4 to 6 weeks, we haven't really seen Angus prices move, sitting on average, $5.20 to $5.40, depends on who you talk to on grids, whereas we've seen the crossbred rate fall from about $4.95 in early February to $4.50, between $4.45 and $4.60, depending on which grid you're looking at this week. So that sharp easing in the crossbred price is what's really driven the widening in spreads, whereas in 2025, it was actually to do with the stability in the crossbred rate and the rally in the Angus price. When we look at May, we've turned the corner after the disruption April brings. May traditionally signals that sort of period when you start to see the last of those sort of cattle traded over summer in northern New South Wales exit the system as feeders, and you go through this sort of lull of a window really until we get to spring and those oats cattle and crop cattle start to move again. May sort of signifies that period where that shortness in supply has begun to be felt for feedlots on Angus cattle. I think we're going to see that again this year, and as I mentioned in detail a moment ago, the South doesn't have the availability of supply themselves to satisfy their own needs. And obviously the Downs feedlots, northern New South Wales yards are in a similar situation. They don't and will not have the available numbers they need to meet their requirements through winter. And I think the combination of both of those factors, short supply in the South, the North not having what they usually are expected to, despite the fact that winter's generally pretty difficult, the North can sort of get away with it a little bit, even though prices do rise. But I think the addition of southern feedlotters this year chasing those Angus cattle for their own branded programs will play a role as well. And the third factor to consider here is, of course, feedlots are now taking that longer term view. They're going to need cattle on feed by the middle of the year for their 150, 200-day programs to be fed right through, processed in a box, landed in China in early Q1 of 26 to get in prior to that quota or safeguard limit being hit again. And I think the combination of short southern supply, short northern supply, strong demand, and the intent from feedlots to access Angus feeders for China programs or destined for China programs is going to combine to really drive that spread again in 2026. I think a dollar a kilo, not out of the question. I'm expecting a dollar a kilo July, August at some stage. And that's why I'm pretty bullish on this spread for those reasons. Moving past that price relationship and just looking at May more broadly for markets, as I mentioned at the start of this episode, I think May is really going to be seasonally defining for how cattle prices perform through the dry season or winter of 2026 and really influence and will give us a good indication of how markets may perform for certainly the next 3 to 4 or 5 months. When we consider May, it's traditionally the largest month of supply, both from a just general supply level and slaughter numbers in the first half of each calendar year. Obviously, we see the north really start to ramp up its first round musters, and that gives those feedlots and processors big lines and big volumes of consistent cattle. And for the southern regions, it's really the month represents the last period or last month of cattle that have been traded over summer. They exit the system prior to winter, and then there's that lull in seasonal supply or sales of cattle out of the south or sort of central eastern Australia south prior to sales restarting when crop cattle start to move again. So it's a really pivotal moment within a year, but I think this year for a number of factors it's going to be even more influential on giving us a guide and an indication of where prices are going to perform. I think we're really going to see the influence of northern supply this year raise its head again. Feedlots are already pretty well chockers. And anecdotally, feedlots are starting to see those big runs and big lines of cattle start to move out of northwest Queensland. On top of that, southern Australia is really beginning to see its seasonal conditions improve. I know it's slow and I say improve and that's general, but they're starting to see consistent rainfall activity out of southern fronts, and also northwest cloud bands start to come through the central of Australia down into southeast South Australia, Victoria, southern New South Wales. So they're beginning to see a gradual improvement in seasonal conditions, and we've already seen it a little bit this week and last week for that matter. Supply really beginning to shorten in those southern markets, which is pretty seasonal, but because of the improvement in seasonal conditions, I think it's going to be more acutely felt as producers choose to retain stock themselves, add a bit more weight, and get back on their feet post-drought. I think that, we've seen it in markets this week really on kill cattle, southern processors really sniffing around and buying in northern markets again because they can't get access to the stock they need locally, because producers are doing exactly that and retaining numbers. I think that additional competition is going to, if they do choose to step into northern markets again, which is highly expected, that additional competition, if it does come, is going to be very important to see how prices perform. And I think the question really becomes, does higher supply out of northern Australia, north of Roma, offset the demand and additional competition from southern feedlot and processor buyers? Or does that additional southern competition lift rates and the higher supply is absorbed between the northern and southern buyers? When you think about the economics of the situation the South is presented with, southern feedlots at the minute can buy feed wheat $70 a tonne cheaper than delivered downs wheat is currently trading at. A difference of about $435 to $450 compared to, say, a $350 to a $365, $370. That discount that southerners can currently access, that key input to their business of roughly $70 a tonne, may prove to be the deciding factor which allows the economics to work for these southerners to come into northern markets. That discount may offset the higher freight rates that they've got to pay because of increased freight costs, diesel, etc. And that may encourage them to go into northern markets more actively and look to secure supply. The relationships had been built in 2025. They were up there actively seeking and looking for cattle. And I think, with relationships established and the ability of southern feedlots to access grain far cheaper than their northern counterparts, I think that will be really important and pivotal to watch. And I think the next couple of weeks in terms of cattle supply out of Northern Australia and how we see markets perform over the next 4 or 5 weeks is going to be very influential in shaping how we see winter overall perform. It's going to give us a much clearer picture, in my view, of what we're really looking at for the next couple of months. And I think some of these factors I've raised so far, improving conditions in the south, high supply out of the north, potential economics favouring the southerners, all of these factors combining, I think, are really going to be solidified and clarified over the next few weeks, which is why May is a really important month to watch for this year and really shaping how we're going to look at the next few months at a price level. That's all for this week. On the next episode, I'm going to jump in and discuss the recently released Q1 2026 ABS slaughter and production numbers. Hopefully, we're going to have the Q1 MLA Alpha feedlot brief out as well, but we'll certainly have a look at those slaughter and production figures and see how the first quarter of 2026 is performing. Those numbers are due to be released on the 19th of May, and I'll put the podcast out on the Friday. So the results will be pretty fresh, pretty keen to have a look at those. For what it's worth, my estimates for quarter one slaughter numbers are to reach 2.28 million head and production volumes to nudge 700,000 metric tonnes. Both of those are good growth, 4 to 6%, depending on which way you look, year on year compared to Q1 25. So good improvements straight out the gates for 2026. If today's episode or any others has raised any questions, please do reach out to me. Send me an email to ripley.atkinson@stonex.com or record a voice note of yourself, where you're from and the question, and we'll get to answering it in the next episode. Feel free to share this with anyone you know. It's important others get access to this information. So, really appreciating those that are sharing it. Have had some suggestions from people come through that they've picked it up from mates passing it on. So please continue to do that. But if you are enjoying it, follow it on your listening platform. But other than that, thank you for listening. And until next time, take care. Cheers.